Right, to continue where we left, since we all now know what margin and leverage is, we calculated our margin to be equal to $106.38, given that our leverage is 1:100, and our standard our lot size is 0.1, which is 10,000 units of the best currency. Now, to demonstrate some of other things that I said I would explain, if we have no open position in our platform, if there's no open position in our platform, initially our free margin will be equal to our equity and will be equal to our balance. So all these three figures will be the same. As you can see underneath here, our balance is 1,000. This is a demo account. Our balance is 1,000, equity 1,000, and free margin 1,000 again. So, and the profit and loss is 0. The moment you open a position, the transaction is opened at the ask price, remember, as I explained to you, and your equity becomes your balance plus or minus your profit and loss. So initially, all transactions, whether short or long, they will all start at a negative. Why? Because of the spread, of the broker spread, the difference between your bid and the ask price in pips. Then in dollars, how do you calculate your spread? It depends on the lot size which you use. And we go back to the table of what? To our table, which I demonstrated to you. Remember, we said that mini lot, which is 10,000 units, which is 0.1, a lot size, the value of each pip movement for a mini lot is $1. The value of each pip movement for a mini lot, which is 0.1 lot size, is $1. So, which means, given that our spread is 2.4 pips, so the loss, or the initial figure which will appear on our profit and loss here when we open a transaction will be 2.4 pips times $1. So we'll have a transaction which will initially be at a loss of $2.40. So that's how it works. So whether you open a short or long position, all transaction will start at a loss because of the spread, and the amount in dollars of the spread, it depends on the lot size which you chose. So let's say, for example, if I had a lot size of one standard lot, so my pips here were going to be my spread in dollars was going to be 24. My spread in dollars was going to be let's check. So the standard lot, each pip movement is $10. So my transaction was going to start at a negative $24 because each pip movement would be $10. Right. And then our free margin will become our equity, which is this one which we have already calculated, minus our margin. Right. So our free margin is the amount of money which is left in our account for us to open another position, to afford to open another transaction. So that's our free margin. It becomes your equity minus your margin. Demonstrating with the example that we had initially. Remember, we had opened our transaction. We had opened our transaction at that at that price, at that ask price, which is 1.06379. So let's have it like this, 1.06379. We opened our transaction at that amount. So, and our margin, we said it's $106.38. So our transaction initially, when it opens, our transaction initially when it opens, we'll have our equity being 1,000 minus $2.40. $2.40, which is the spread, and which is the spread which you calculated. So initially when we open our transaction, our profit and loss, our equity will be $997.60. That will be our equity initially. And our free margin, it's going to be $997.60 minus our margin, which is $106.38. I'm just rounding up to 2 decimal places, right? So our free margin will be $891.22. That will be the amount which will appear here as a free margin, and that $997.60 will be the amount which will appear here as your equity, and your $2.40 will be the amount which will appear here as your profit and loss. And the displayed amount of your balance here, it remains unchanged. Your displayed amount of balance here, it remains unchanged up until you close your positions. That's when your balance will become that. That's when your balance will be will become that equity. That's when your balance will become. That's when your balance will become the equity at that time when you close your all your positions, right? And so if you don't trade with stop losses, as I explained before, that depending on your strategy, on your risk strategy or trading strategy, you might put your take profit or stop loss at certain levels from your entry position. Like if you don't trade with your stop loss, your free margin is actually the entire amount of money that you have exposed. Why? Because the margin, the broker holds back. The broker holds back your margin. Your margin is the amount of money which is needed to maintain your position or to keep your transaction open. So the broker holds back that margin, right? So when the broker holds back that margin, right, then your equity, when the broker holds back that margin, the portion which is left, will become the portion which is left of your equity will become your free margin. So that's the amount which is that will be the total amount exposed in the exposed to the market. That is if you don't have any risk strategy or you didn't put any stop loss. So we have your balance initially. When you open your position, then your equity becomes your balance plus or minus your profit and loss. Then the broker, remember, it holds back a certain portion of that equity to maintain your position. You see, so the free margin actually will fluctuate. Your free margin and your equity will always fluctuate depending on the positive or negative pips. your transaction is losing or gaining. So when your transaction is making profit, which means you're making positive pips, the price is going in your favor, you'll see your profit will be increasing. And if your transaction is making a loss and making negative pips, you'll see your profit and loss figure here decreasing. So does your equity and your free margin. When you're on the negative, when you're going to the negative pips, the price going against you, your free margin will continue to decrease and your equity will continue to decrease. And conversely, the opposite happens when price is going to your direction. The margin level, it doesn't appear here. It appears when you have opened your position. It appears when you've opened your position. Your margin level is the ratio of your equity to your margin expressed as a percentage. It's a ratio of your equity to your margin expressed as a percentage. It's good for you to go and practice to actually open a transaction. It's only that today the market is closed, as I said. So it's good when the market is open so that you can actually understand what these things are. I mean, in case of the fluctuations that I was explaining, right? So maybe if Monday, when the markets are open now, then you can experiment it yourself so that you can see these figures fluctuating and you can see the margin level. Right. Then we have what we call your stop out and your margin call. Your stop out, your margin call is whereby your profit and loss, your losses have depleted your equity to the level that your margin is now equivalent to the equity. So the ratio of your equity to margin has become like 1. So that's that's when the stop out level happens. So what the broker does at that point, they close your losing position, starting from the highest, starting from the biggest loser. So that's a stop out. Stop out when your equity, the ratio of equity and your margin is equals to 1. You have lost enough pips or enough money. Your equity has depleted up until it is equal to your margin. Remember, it depends with some brokers. Some brokers do not actually, they do really stop you out or give you a margin call before you reach your stop out level. Say some brokers, you can go up until a negative amount, like you can lose more than you actually have in your account. So your margin call is a certain percentage level or margin level, which is always slightly above your stop out level. Maybe if your stop out level, since your stop out level will be 100%, your margin level will be at 100%. See, that is the a standard one. Even though brokers can go further up until your margin level goes below 100%, it goes to 90, 80. See, but in actual theory, your stop out level must be at 100% when your margin level is 100%, when the ratio of your equity to margin is 1. Your margin call will be when your margin level is slightly greater than 100%, just before you actually reach your stop out level. The broker gives you a warning that your funds are depleting, so you must put more funds in your account so that you can be able to still maintain your position. Because depending with the broker, some brokers deplete your equity up until it goes to the negative, and if it goes to the negative up until it's the negative cancels out your margin, then that's when they completely close your positions. So which means they will still give you a chance to hold your to hold your position even though your equity is at negative. But the moment you close your position, they will take your margin. They won't put back your margin into account as how we know it. Like if you are trading right your margin, they hold it back. Then when you close your positions, they put it back into your what? Into your balance. So some brokers, they allow you your transaction, they will allow your equity to go to negative. And if it goes to negative to a figure which is now greater than the what? Which is now way greater than your margin, then they that's when they actually stop you out and close all positions, and you don't get back your margin. So you get to blow off your account. So it depends with the broker which you are using, and you have to find out about that. So just to give a visual demonstration of what I'm trying to explain here, what I was explaining to you about equity margin, free margin balance, and your profit and loss. So when you open initially, when there's no position open, right, your balance will be from here to there. When you open a position, right, your equity and your free margin will start to what? Will start to fluctuate. Then your equity, which is will become from here to here, will be your balance minus the what? The profit plus or minus the profit and loss, of which we said initially it will start at a what? Your transaction will start at a loss, which is the spread. So your equity will be from here to there. Then your margin, which will be a fraction of your balance or your equity, will be from there, here to there. That will be your margin. Then your free margin, will be your equity minus your margin. See, your free margin, which is from here to there, will be your equity minus your margin. Then you get your free margin. If you add that $2.40, given that we can make it static when the markets are open, if we add that $2.40, you on top of your free margin, on top of your margin, you'll get your balance. Or if you add that $2.40 on top of your equity, you'll get your balance. So that's how these equity margin, free margin, balance ratios can be represented, so that you can have a visual impression of how actually the profit and loss affects your margin and free margin, your free margin and your equity, and also your margin level. So when your transactions are open, your margin, free margin, and your margin level, those are the three things that will be fluctuating, including the profit and loss as well, depending on the negative or positive pips you are gaining or losing respectively. Right. So if when it comes to the choice of the lot size, what a lot of traders will ask, and what lot size should I use if I'm opening my position? It's kind of like more something which is attached to how you do your risk strategy, because the lot size which you chose, you must consider the leverage of your account, because that leverage, it determines that leverage of your account, it determines your margin. It actually has you'd say in your in how much the broker will require from you, would hold for you to maintain that position. So when you are choosing, depending on whatever risk strategy you are using, if you're choosing a lot size, these are the things that you must consider. Your leverage, let's consider your leverage and your balance, how much you have in your account, because your leverage and your lot size will determine your margin, the amount of money which will be required for you to open that, to hold or to maintain that position. So in terms of a risk strategy, there's what we risk management. In just simple terms, there's what we call risk. There's what we call the risk reward ratio. Risk reward ratio. The risk and reward ratio is basically how much you are willing to make against how much you are willing to lose. Let's say, for example, you are willing, you have got a risk reward ratio of 1:3, which means for a certain pips or certain dollars, you're willing to make times 3 of what you are willing to lose. But you must be careful when actually with some of these standardized things, because you don't really need, some people might say, all right, I just trade 1:3, 1:2, or 1:2.5. But in reality, sometimes it doesn't make sense to maintain the same risk reward ratio. Why? Because the market will not move with the amount of pips as per your anticipation or your expectation. So there are different market setups. Sometimes, even though not absolutely obvious, you can see that this market will never move from this level where we bought. You can see that this market will never move by more than 200 pips going up. So if you could put in whatever lot size you'll be trading, if you could use a certain risk reward ratio, maybe 1:3 or 1:4, but you can just certainly see that this market won't make 200 pips before actually coming down. So there's no need for you to stick or to have a constant risk reward ratio. It must always depend on the what? On the setup, market setup, or your high probability entry that you have at that time. So it's not something which is always constant. So I would like, I usually say that a risk reward ratio is just a myth. You say, because you can't expect me to be mechanical when it comes to choosing which risk reward ratio I should use. Sometimes the market, you say, it moves whether you choose which risk strategy to, the market will just go its own direction where it wanted to go. It won't go considering your own opinions or decisions or strategies or anything. But what I would advise you, what I can advise you is your account will be much more exposed. Your account will be much more exposed if you have got a small balance, and it's highly leveraged, and you are busy trading huge lot sizes. Let's say, for example, you have got like $200 in your account or $500 in your account. Do you know that having that account leveraged at 1:500 and trading 0.1 standard lot, that's a lot of risk that you're taking there, because no matter how much win rate you might have, of very, very good in putting stop losses where your broker cannot reach out for it, but that's a huge that you'll be taking quite a lot of risk there, because having an account of 500, let's say at that point in time when you're opening a transaction and your account is standing at $535 and you open a 0.1 lot size position, remember it's 0.1, a 0.1 lot size position, it's each pip value will be $1. So if the market moves against you 200 pips, so against you 200 pips. So you would have went negative $200 if you didn't put a stop loss. And even if you put a stop loss of 40 pips, you would have lost what? $40. So that's why I'm saying that when it comes to a risk reward, when it comes to a risk reward ratio, it's actually a myth on itself, because you can't expect me. It's more of like it's more of like a too mechanical way, and it touches, it's, to me it's out of reality, to be honest. Risk reward ratio, it's a little bit out of reality. See, I know you might try to have a discipline so that you can follow your trading strategy. It's good for beginners. It's very, very good for beginners. You can follow it, but you cannot just pick a certain constant ratio and just apply it every time you open any position. The market always have different setups, and the expected positive pips or negative pips your position can experience will always be different time and again. Say, and might not meet the target amount you are expecting, or your strategy is actually indicating you to what, to take profit at that level or stop loss at that level. See, the risk reward ratio might not seem to pay out very well if used constantly and not properly and more objectively. Okay, right. I think for today we are done. Thank you very much. Please check out the YouTube channel BlackChild-fx, and also find us on Facebook at BlackChild-fx. Thank you very much. Bye.